When you open up a chart, what's the very first thing your eyes go to? Most people look at the candles. Some traders slap on a bunch of indicators. Others start hunting for patterns. But the single most important piece of information sitting right there on your chart, you completely ignore it. And that thing is volume. Here's the deal. A candlestick only tells you what happened. Price went up or price went down. That's it. But volume tells you the story behind that move. It tells you how much money was actually behind that price move, how many traders participated at that level, and most importantly, whether that move is real or just a fake out designed to trap you. So in this video, we're going to break down how to actually read volume on a chart, what volume really means, and how to use it in your trading. And stick around till the end, because I'm also going to give you a simple 3-step checklist that you can use before every single trade. Let's start from the absolute basics. The candlesticks only show you what the market did. Price moved up, price moved down, or it's consolidating in one place. In other words, candlesticks help you visualize the movement of price. But the full story behind those moves? That's what volume tells you. Volume shows you how many traders participated in that price move, how many buyers and sellers showed up at that level, and how much money was actually flowing in that direction. Let me give you a concrete example. Say the S&P 500 makes a 50-point rally to the upside, and the volume during that move is significantly higher than average. That's a clear sign that a large number of traders backed that bullish move with real money. They put their capital behind it. That move is genuine, and you can trust it. But now flip the scenario. The S&P 500 makes the exact same 50-point rally, but this time the volume is really low. That means very few traders actually participated in that move. There's no real conviction behind it. And moves like that? They don't tend to last. More often than not, they reverse. So from today onward, whenever you look at a chart, don't just focus on where the price went. Always check how much volume was behind that move, because without volume, that move has no real strength behind it. Now let's get into the most important part. If you understand this one concept, reading volume on a chart will become crystal clear for you. This concept is called effort versus result, and I bet nobody has ever taught you this before. In the market, effort means volume. How much money is being put into a particular level? And the result means the candle. How far did price actually move from one point to another at that level? When you look at both of these together on the chart, that's when you start seeing the real picture of what the market is actually doing. To understand this properly, we need to look at 3 different scenarios. Scenario number 1, high volume plus big candle. This first scenario is the most straightforward. If the volume is high and the candle is also big, it means a lot of effort went in, and the result matched that effort proportionally. Both things are pointing in the same direction, and everything looks normal. This is considered a healthy, trustworthy move. When you see effort and result aligned like this, you can have confidence in that move. Scenario number 2, high volume plus small candle. This is the most important scenario of all, so pay very close attention. If volume at a certain level on the chart is extremely high, the volume bar is way bigger than the surrounding bars. But the price candle is really small. That means a ton of effort went in, but the result was nowhere near proportional. And this is a massive warning sign for you. What's actually happening here is this. On one side, buyers are aggressively buying with everything they've got. But on the other side, a very large player, what we call smart money, is quietly sitting there absorbing all of those buy orders. They're selling into that buying pressure, but they're doing it so cleverly that the price doesn't immediately drop. This process is called absorption. And once the buying pressure at that level runs out and the buyers are exhausted, there's nobody left to push the price higher. That's when price often collapses sharply. Spotting this on a chart is actually pretty easy. If a stock's price has reached a resistance level and volume is through the roof, but the candles are getting smaller and smaller, and you're also seeing long upper wicks forming on those candles, that's smart money selling into retail buying. When you see this, you should absolutely avoid taking any buy trades near that level. Scenario number 3, low volume plus price still moving. In this third scenario, If price is steadily moving up on the chart but volume is very low, it doesn't mean buyers are super strong. It actually means sellers have completely disappeared from the market. Nobody is willing to sell at these levels, so price faces zero resistance on its way up and moves higher with very little effort. This condition is called no supply. And the exact opposite works the same way. If price is drifting lower and volume is also very low, that's called no demand, meaning buyers have zero interest in buying at these levels, so price just keeps sliding down on its own. Let's have a quick summary of these three scenarios. First, high volume with a big candle means it's a healthy, genuine move that you can trust. Second, high volume with a small candle means absorption is happening, which is a warning signal that a reversal could come at any moment. Third, low volume while price keeps moving in one direction means the opposite side is completely absent. This kind of move lacks conviction, so you should be very careful about entering trades in either direction here. Make sure you lock these three concepts into your memory, because everything I'm about to teach you from here on is built on top of them, and it's going to completely change the way you look at volume on a chart. Have you ever heard of volume spread analysis? I'm guessing about 90% of you are hearing this term for the first time today. A lot of traders call it VSA for short. There are three key patterns within VSA that every single trader needs to know, so let's learn them one by one. Pattern number 1, stopping volume. Imagine the market has been falling non-stop. Red candle after red candle is printed on the chart. There's panic everywhere. Traders are scared out of their minds and rushing to exit their positions. Looking at the chart, it feels like the market is going to keep dropping forever. But then suddenly, a candle appears on the chart. It's bearish, it's noticeably bigger than the ones before it. And, here's the key part, the volume underneath it is massive, way higher than anything you've seen recently. Now, if you look at this candle closely, you'll notice it didn't close at its lowest point. Instead, it formed a long wick on the lower side and closed back up around the middle 50% of its range. Meaning, the price went down hard, but then got pushed right back up. What this tells you is that a big player, smart money, quietly stepped in and absorbed all of those panicked sell orders. All those traders who were dumping their positions out of fear, a massive buyer was on the other side, soaking up every single share. That's exactly why volume was through the roof at that candle, but price didn't actually go any lower. This is a textbook effort versus result mismatch. Huge effort to push the price down, but the result didn't follow. This creates a possible reversal zone where price has a strong chance of heading back up. So when you see this setup, you should absolutely avoid entering any short trades. Instead, start watching for signs that the market is getting ready to turn around. Pattern number 2, buying climax. Now imagine the exact opposite scenario from the first pattern. Prices have been grinding higher for a long time. The bullish trend is all over the news and social media. Everybody's talking about how strong the market is, and small retail traders are piling in, buying aggressively because they're terrified of missing out. Classic FOMO. Then you see a big green bullish candle form on the chart, and underneath it, the volume is the highest it's been in the entire move. Most traders would look at this and think, this is incredibly strong buying. The market is going even higher from here. But the reality is the complete opposite. What's actually happening here is a distribution phase. When smart money needs to exit their enormous positions, they can't just dump everything at once. If they did, price would instantly crash from that level. So instead, they wait patiently for the moment when small retail traders are buying in a frenzy, riding the excitement and euphoria. And right inside that buying pressure, smart money quietly sells off their positions piece by piece. This is exactly why you see those small corrective pullbacks within bullish trends. Smart money is methodically distributed, selling into strength, and those little dips are the fingerprints they leave behind. So in any bullish trend, whenever you spot the biggest green candle of the entire move forming at the higher levels with the highest volume bar underneath it, always be on high alert. This could be a signal that the bullish trend has reached its top. The market could very well reverse and head down from there. Don't let the excitement suck you into a trade right at the worst possible moment. Pattern number 3. No supply test. Let's say there's a solid uptrend playing out on the chart, and suddenly price pulls back a little. Naturally, the question that pops into your head is this uptrend about to reverse, or is this just a healthy correction? This is exactly when you should look at volume. If that pullback consists of a small red candle with very low volume, it means sellers have no real interest in selling. Nobody actually wants to bring this market down. What the market just did was run a quick test. It checked whether there are any sellers willing to step in at these levels. And the answer came back, no. This is called a no supply test, and it means the uptrend is very likely to continue. In fact, this can actually be a great buying opportunity because selling pressure is virtually non-existent at this point. Now, before we go any further, there's a very important thing we need to address. A lot of traders believe that a green volume bar means buying happened at that level and a red volume bar means selling happened. But this is completely wrong. Here's why. Every single trade in the market requires both a buyer and a seller. If you bought 50 shares, someone else sold you those exact 50 shares. Volume simply tells you the total number of transactions that happened. It does not tell you who's in control at that level, buyers or sellers. The color of the volume bar just follows the color of the candle. If the candle closed higher than it opened, meaning it's a green candle, then the volume bar shows up as green. If the candle closes lower than it opened, the volume bar turns red. That's literally all it is, nothing more. So here's the takeaway. Stop paying attention to the color of the volume bar. The only two things you need to focus on are, 1. How big is the volume bar compared to the others around it? And 2. Where did the candle close? Size and close position. That's it. Those are the only two things that matter. Let's now take everything we've learned and turn it into a simple, practical process that you can start using in your trading today. Just follow these 3 steps before every trade. Step 1. Look at the big picture. Before you zoom into any single candle, take a step back. Pull up a 15-minute chart or higher time frame and ask yourself, is overall volume increasing or decreasing? Is there any unusual volume spike that jumps out at you? This big picture view tells you whether overall trader participation in the market is growing or fading. It sets the context for everything else you're about to analyze. Step 2. Focus on key levels. Now identify the most important support and resistance levels on your chart. Then watch how volume behaves when price reaches these levels. This is exactly where the effort versus result concept comes into play. If price hits resistance and volume spikes dramatically but the candle stays small, that's absorption. The resistance is strong and you should not be entering any buy trades there. If price breaks through resistance with a big, strong candle and high volume to match, that could be a genuine breakout that you can trust. But if price breaks resistance on low volume, be very careful. That's likely a false breakout or a trap designed to catch you on the wrong side. Step 3. Wait for confirmation. And this is the step where most traders mess up. They see a breakout happen and they immediately jump in. Don't do that. Instead, wait for the next candle. If after the breakout, price pulls back slightly and that pullback happens on low volume, that's a no supply test. And that's your confirmation that the breakout is real. Now, you can enter the trade with confidence, knowing that the other side has no interest in fighting this move. If you found this video helpful, don't forget to like the video and subscribe to the channel. Thanks for watching.